Hi, my name is Richard Hutton and welcome to the Exponential Fund, the place where you learn to invest and absolutely crush average market returns. Today is 10th of April and time for another update. My strategy, the Exponential Fund, had a pretty rough week, down 5.18%, whereas the broader market, the S&P 500, was down only 1.22%. Macro. So, as a quick recap of the trades that I did, the rebalancings. On Wednesday, I trimmed my Vertex position. I made 15% gain in less than 2 months. So again, I just sold a little bit of it because it got quite far away from my average position. And of course, with that money, I then bought things which were down in my portfolio. I will use this rule from now on. So, as you may or may not know, I invest an equal amount in the 20 largest companies that have been growing their sales by at least 10% every year for the last 5 years. Yeah. So I have 5% of my portfolio in each of these 20 companies. And obviously after, a day, a few weeks, some stocks go up, some stocks go down. So some stocks become more than 5% and other stocks become less than 5%. And what I do is I rebalance. I sell some of the stocks that went up, and with that money, I buy more of the stocks that went down. Essentially, buy low, sell high, but without having to predict what the stocks will do. So I will have this specific rule, like when to do this rebalancing. When a stock gets 10% away from the average. So when a stock becomes 5.5% of the portfolio or 4.5%, right? Like whichever hits first, I will adjust. All right, on Friday, I bought more Shopify at $611.23. So just, a couple of trades for the week. Now, here's a thought. Just a random tweet I had. For me, it's easier to predict what a stock will do 5 years from now than 1 year from now. Think about that. All right. Now, for a more in-depth lesson, train of thought, about this idea of having a trade that is safe, safer, and safest. You got to understand, we as investors, if you pick individual stocks, your goal is simply to beat the market, to earn more than the S&P 500. Okay, so you need to understand the competition. How is the S&P 500 so powerful? Why is it that the vast majority of professional money managers earn less than the market average? If they're supposedly so smart, why can't they do their jobs? Something is wrong. Yes. Because it's not enough to have high IQ. I do believe these guys are fairly intelligent. Yet, obviously, because of their poor performance on average, they must somehow end up making stupid decisions. I believe that is because of unconscious biases. Not fucking racism. No, I mean investing. Like, Jesus. Like thinking short-term versus long-term. Like thinking linearly, not exponentially. Like being a little bitch and being afraid of volatility. So, stuff like that. Now, how is the S&P 500 put together? Well, the criteria for a company to be in the index is essentially to be large and profitable. That's it. Now, what does the index not care about? It does not care what industry is in. It does not care who is in the management. It does not care about valuation. It does not care about timing the market. It does not care about volatility. Could we learn something from the S&P and simply construct a strategy that is based on that framework, but like tweaking it just a little bit? That is essentially what I've done. So instead of big and profitable, I said, wait a minute, there's a potential loophole that a company could be big and profitable, but declining. Yes. And I showed this before. There are sites where you can screen stocks based on certain criteria. The one I like is finviz.com. And you can put the criteria sales growth for the past 5 years to be negative. And if there are any stocks in the S&P 500 with this criteria. Yes, quite a bit. There are quite a bit of even large companies who are profitable and declining. What the fuck? Why would you want any of your stocks in your portfolio to be declining? That doesn't seem smart. So I said, instead of looking at profitability, because some of these even large, high-growing tech companies are not net profitable because they invest so aggressively in the future. So wouldn't a better proxy, a better indicator would be simply sales growth? I mean, that's where everything starts, right? Sales and then everything else. So that is what I do. I invest in the largest companies that are growing fast. But on this idea of safe, safer, safest, every year I create my watch list of, and I just did this last week. I look at which stocks are larger than 10 billion and have been growing their sales by at least 10% every year for the last 5 years. This year I got like 82 stocks. Now, when I go to FinViz and I tell it to show me all the stocks, there are over 8,000. So my watch list is essentially 1% of the stocks on the market. So 99% of the companies are not good enough for me. I want the largest, fastest growing companies. But even still, I do not invest in all of them. In my strategy, the exponential fund, I pick the largest 20 out of that, just for scalability and safety reasons. But I thought about slicing and dicing this set of data a bit more. So I look at 3 indicators for risk and potential opportunity. I look at market cap as a proxy for risk. Risk not as in volatility, but risk as in, let's call it probability of going bankrupt over the next 5 years, or probability of the stock being higher 5 years from now, whichever you like. So generally speaking, the larger the market cap, the lower the risk, right? So sure, there are some, $20 billion companies that are riskier than some $15 billion companies. But generally, a $1 trillion company will be much safer than a $1 billion company, right? Let's think in orders of magnitude here, not slight percentage increases. Okay. Then I would look at sales growth rate over a multi-year period as a proxy for future opportunity, as an indicator of where are we on the S curve, right? The slower the growth, I would say the later we are in the S curve, and the higher the growth, the earlier we are. Sorry, I'm not going to fuck with the mic anymore. Right? And then the third indicator would be, which I only use occasionally, is the discount, as in how much did the stock crash from the all-time high, right? So, if you wanted to just pick the safest investment, like the one stock, obviously this is not investment advice, it's just my opinion, go for the biggest out of these 82 stocks, right? So that would be Microsoft, market cap of like $2.3 trillion and sales growth last year of 17%. It's okay. It's not hyper growth, obviously, but that's like super safe. What is the probability that Microsoft will go bankrupt next year? Almost zero. It's not zero, but practically it is zero. What is the probability that Microsoft will grow its sales next year? Very high, in my opinion. Not by a huge amount, but a decent amount, Next, if we go down a notch to something a bit more risky and with a bit more opportunity for gains. Here's what I did. So for once, I ranked all the companies, those 82, by market cap, 1, 2, 3, so and so. Okay. Then I ranked the 82 companies by their sales growth of last year. Right? Fastest growing number 1, second fastest number 2, and so and so. Then I ranked them by that metric. Right? And now each stock had 2 rankings. One rank based on market cap and another rank based on their sales growth. And here's what I did. I added up those 2 numbers and then I ranked them by their sum. Make sense? So the one with the best score was at the intersection of large and fast growing. And guess which was number 1? Tesla. Surprise, surprise, Tesla is by far my largest position in my personal account, in my main account. I said the exponential fund, the strategy, that's an equal amount in the biggest 20 companies. But in my other account, where the a good portion of my net worth is, that's the biggest. So that's nice. The third variable would be how much is it down from its all-time high. Now, if we assume that these companies will continue to grow for the foreseeable future and the stock crashed a lot, eventually the stock would go up. But the more it crashed, the more it has to catch up just to go up to its all-time high, right? So if the stock is down 10% from its all-time high, it has to go up 11%. But if it's down 50%, it has to go up 100%, right? So there's a exponential increase in the amount it has to go up. So I added that variable too. How much is it down from its 52-week high? And I ranked them. And now I added all those 3 ranks. And now the stock with the best score was the largest that was growing fast and was on a huge discount. And this is a different company. It's C Limited. And I have made a small purchase in a separate account. This is simply, let's call it research and development, right? I put a small amount to test this hypothesis. This should be an indication of, let's say, medium-term, short to medium-term growth, right? Over the next 1 or 2 years, this stock, C Limited, could go back up to its all-time high. And if it does that, it has to go up like 200%, which is pretty crazy. At which point I will sell and then look for the next stock, which is at the intersection of large, fast-growing, and large discount, right? So, as you see, Microsoft, the largest, but not growing very fast. Tesla, a bit smaller, growing super fast. And then C Limited, it's, way smaller, market cap of like 60 billion, growing very, very fast. I think over 100% last year, and down a lot. So that could have a huge run-up in the foreseeable future. Obviously, this is not investment advice. This is just me rambling on. Till next time.